mindset.
Okay, can you see our shared screen? Do you see the shared screen?
I do now.
Okay. All right. Tonight we're going to talk about IRS audit considerations. When I did this in 2017, the latest data that was available was for 2015. And I look at it basically every year and it doesn't materially change. In 2015, they audited 1,166,379 returns, which was about less than 2/3 of 1% of all the returns that got filed. We're talking individual returns. They audited 1,034,955 individual returns, which was about 70% of all the individual returns that got filed. Last year, I think they had almost 140,000, 140 million returns that got filed. Out of all the audits they did, over 70% of them were correspondence audits. And you say, well, what's a correspondence audit? The IRS, as you well know, as employers do W-2s, they have to send a copy to the IRS. Actually, it goes to Social Security Administration. Social Security gives a copy to the IRS. When people file a 1099, they have to give a copy to the person that gets the 1099. They give a copy to the IRS. So the IRS collects all the data in these, from all these 1099s that get filed, all the W-2s that get filed, all the forms and various and sundry things that get filed. And they then use their computer to compare what got filed with them from the originating source with what got filed for an individual on their individual tax return. And if they identify something different, then they send a letter, computer-generated letter. You know it because you see the letter from the IRS has a CP as a letter number, computer processed. And those are what are called correspondence audits. As a CPA, if I get, for example, somebody sends a 1099 NEC that should have been a 1099 MISC. We will put the 1099 on their tax return. We will put a note on the tax return that they received a 1099 NEC, but what they received was for property that they rented. And that should have been reported on a 1099 MISC. And we're going to zero out the Schedule C that the 1099 NEC goes to and report the dollars that were reported on the 1099 NEC on Schedule E for property, for rental properties. That's an attempt to keep my client from getting a correspondence audit. Because if they got a 1099 NEC and we didn't do anything, the IRS would identify a difference and they would send them a computer generated letter saying, we had so-and-so report 1099 NEC for X, and you didn't report it on your tax return. So we do our best to eliminate as much as possible any correspondence audits that would come from the computer matching things or not getting, or trying to match things and not getting a match. So that's what correspondence audits are about. And if you see that we generated 70% of all the audits we did were correspondence audits, actually what they did was somebody going out and to someone's house and auditing them, or somebody asking someone, or the IRS asking someone to come into their office to have an audit done, was about 300,000 audits. So out of 140 million tax returns that get filed, to actually have 300,000 of them audited, and it just minuscule, less than 1%.
These audits, are they just something that the IRS feel that they have to do just to keep the pastors in check, or is it just mandatory?
They have a certain number that they try to do every year. And some of them don't make sense. I mean, I understand why they did it. I had a client one time that got audited by the IRS, made less than $30,000 in a year, reported all that he made on his tax return, and the IRS decided they wanted to audit him because they had decided he probably had unreported income. So when we could show the IRS that his bank statements and all his, you know, he didn't have any income coming in other than what was reported, and he was running up balances on his credit cards to continue to pay his bills, then the IRS said, okay, we're okay. We don't have a change. And that's what we, so the IRS, they have a certain number that they feel like they have to do every year just to make sure some people are honest what they do. But as you can see, the vast majority of what they do, they let the computer match, and they don't send somebody out or do an audit. Now, if you're going to, if you owe money and you ask for a payment arrangement, then you have to fill out a financial statement. And we'll talk about that a little bit more later. They may very well decide to audit you because of that. So it's usually other things that would trigger other than just, you know, luck of the draw that happens to come up.
Okay, out of that million that they have, that number of that million that was audited, is that one state or is that several states?
That's all, the whole US.
Oh, okay.
That's the entire US. And the entire US is what I talked about, where we got 140 million in returns filed.
Okay.
Now that's corporate returns, individual returns, partnership returns, you name it, trust returns, et cetera, et cetera.
Okay.
Everything got filed, about 140 million returns, and that audited 1 million of them.
Okay.
And basically 300,000 of them, somebody went out to see, and the other 700 and some odd thousand, they sent them a letter and waited for them to respond to their letter. And it's been that way at least for the last 10 years.
Okay.
Now, my clients get a fair number of letters every year, but we do everything we can to eliminate as much as possible those letters, as I told you. So of the individual returns with less than 200,000 adjusted gross income and non-farm business income between 25 and 100,000, that audited 1.742% or 55,597 returns. Now, I chose less than 200,000 AGI because if a preacher has his wife working, they're probably going to make less than 200,000. And his non-farm business income is going to probably be between 25 and 100,000. So this would be where most preachers would fall in that category. So in that category, as you see, the audit rate went up from almost 70% to 1.7%. Then I took another sample of the individual's returns with less than 200,000 AGI and non-farm income in the next tier up from 100,000 to 200,000. They audited 19.691 returns or 2.218%. So they try to audit based on, well, they have two different types of audit. They have a audit that covers everything that happens. And they ask you, if they get picked for that audit, they ask you to give them a year's worth or 18 months worth of bank statements. And they go through your bank statements and they look at your bank statements, and every deposit you made, they ask you to justify where it came from. They do very few of those audits, but the reason they do them is so they can see, based on those audits, what problems generally exist in the universe as a whole. So if they found that in this audit, they audited a preacher, for example, and they found that he didn't report on Schedule C all his non-salary, all his extracurricular activities like weddings and funerals and all that stuff. If they found out he wasn't reporting that, then they would say, well, let's look at, every time we look at a preacher, let's look at this particular aspect of the preacher. Is he reporting fees that he earns elsewhere other than where he works full time? So it's fees that he would earn for meetings or other things that he did, weddings, funerals, etc. So let's look at that. And if they figured out that he wasn't doing the decent rule properly, then every time they would get an audit that it would involve a preacher, they would say, well, let's make sure he does the decent rule properly, because we've got evidence that says preachers aren't going to do that right. So that's the reason they do the individual audits. The rest of the audits just happens to be luck of the draw. The computer will pick a random sample of people, and just based on the luck of the draw, the IRS will go and audit them. Now, they try, at least in the computerized, the random audits, they try to focus more on the higher income people to do audits on. So for example, they have a division that they call large business and international. And those people will get audited generally every 3 years, with 3 years being the normal rule because their statute of limitations is 3 years. So when they audit them, they will audit them for 3 years. So that if they find something on year number 1 or year number 2 or year number 3, they will assume that the same thing happened on year 4, 5, and 6. And they will assess those penalties or interest or whatever additional taxes. They will assess those based on what they found on their sample of the audits. But the large business and international, they generally try to audit every return they do with a 3-year period window. So small business partnerships, small partnerships, individuals that make less than 100 or less than 200,000, you see there that they audit less than 2% or about 2% of what they do. So it's just random sample. And if you get lucky enough to get selected by their computer, you get audited. If you don't get lucky enough to get picked, you don't get audited. So now, turning away from the actual audit work, one of the things they do in the audit is compare your return to some averages. So for example, in 2014, they had in itemized deductions, they had the average taxpayer claimed $11,933 in taxes, which then gives you an idea of why it's currently limited to $10,000. Because if they made it 25 or 50,000, it wouldn't affect many people. But if an average person said, I'm going to claim $11,933, that's state income tax withheld, sales and local taxes, property tax, anything having to do with taxes, car tag taxes, et cetera, et cetera. If you go in and you're claiming 20,000, now that would have been 20,000 before it's limited to 10,000 under the current law. But if you were claiming 20,000, say in 2014, then they may decide to audit that area of your return, just the taxes piece. Okay, we want to see it. Interest, home mortgage interest, 9239 was what was commonly claimed, average claim in 2014. If you claim $25,000 or $30,000, now, since about 2010, they have been getting 1098 from the mortgage companies. So if your interest deduction agrees with what the mortgage company reported to them, they got computer generated matches there. But if your interest claimed exceeds what the mortgage companies reported, then they may very well audit you for that. Charitable contributions. The average was 5,814. Now, for preachers especially, most of them give more than $5,814 in charitable contributions. So they look at everything else and say, does this make sense for this person? So does it make sense based on what they did prior year? Does it make sense on people similar to them? Does, you know, we may have something we want to look at there. With the IRS having the requirement that the charitable organization send out letters for every contribution made in excess of $250, they've limited how much they audit for charitable contributions. Because if they have a fair number of letters, now, along with those letters, there are a couple of rules. You got to have the letter before you file the tax return. It's not enough to say, well, I'll get the letter if I need it. Because if you don't have it in hand before you file the return, then the IRS won't allow the deduction. So there's a lot of rules that trip people up here. And we've had situations where people try to deduct something and they didn't have the letter in hand before they deducted, before they file the return. The IRS audits them and says, nope, not going to allow that deduction. So with the ruling on the letters, it's gotten to be fairly good that, you know, you got to have something in hand to justify the charitable contributions. Miscellaneous itemized deductions. Now that changed in 2018, where there's very few miscellaneous itemized deductions. Used to be that what you paid someone like me to do a tax return for you, what you paid a brokerage firm to manage your investments, was all deductible as a miscellaneous itemized deductions. But when they did away with, when they increased the standard deduction, they did away with miscellaneous itemized deductions for most people. Moving expense may be another miscellaneous itemized. They did away with that. except for those people who are in the military. So military can still do that. Most other people can't do it. I just had a nephew that they moved to Japan. He's in the Army, flies aircraft for the Army, and they moved him over there. So if he had some costs that he had to incur, he would get to deduct those. But for most people that move, that's not the case any longer. People, we talked about taxes earlier. The people, the average income taxes were $9,589. The average real estate taxes were $4,851. Now, income taxes, real estate taxes, both are in that taxes and local taxes number, sales and taxes, etc., that they've limited to $10,000. So if you see those average itemized deductions, it's almost $15,000, 14 something, $15,000. Once again, on 1098s that come in on mortgage companies, a lot of the mortgage companies report on the 1098 how much is real estate taxes that they paid out of an escrow account. So the IRS has a quick way using 1098 data to see what the real estate taxes are and to compare them to what you report on the return. Mortgage interest. Once again, the 1098s will give you that mortgage interest number. If you don't have a 1098, if you've got, didn't have a mortgage, say somebody individually holds your mortgage, they should send you a 1098, but there's a place on Schedule A to report who holds your mortgage, and they ask for their social, and the IRS is going to compare those two. What you're deducting as mortgage interest, what they're reporting as mortgage interest. So they're going to make sure that they can link those two together and make sure they're appropriately deducted and claimed as income. On cash and check contributions, 4,708 was the average there. And unreimbursed employee business expense, that's the miscellaneous deductions for, we don't have those 2106 we talked about last week, and unreimbursed employee business expenses. Don't have them anymore, 2018 through 2025. So with those, with the change in the increase standard deduction and the elimination of certain things not being eligible to itemized deductions, more and more and more people, it's estimated right now that about 80 or 90% of individuals are doing standard deduction, especially those who have paid off their mortgage, because they don't have enough. Without the mortgage interest, they don't have enough. And in Georgia, I know a lot of counties, in Cobb County, for example, once you turn 65, you can eliminate the school tax on your property tax. Took about 70% of my property tax. So I pay less than, pay about $1,000 now, whereas I used to pay between $3,000 and $4,000 in property tax every year. So, you know, as you get older, as you pay off the mortgage, you generally don't have a lot of itemized deductions, so you take standard deduction. And especially as the higher limits have gone in on the standard deduction, very few people are doing itemizing. One other thing they will look at for a minister is employee versus self-employed. I.e., did you get paid on a W-2 or did you get paid on a 1099 NEC? Now remember, the IRS always considers a minister as an employee for income tax reporting purposes, but as self-employed for Social Security reporting purposes. Being paid on a 1099, at least paid for the majority of what you do as a minister, could be a red flag for audit. If you get paid every year, you know, you could be subject to an audit because you're getting paid on the 1099. And if they audited ministers and their, you know, everything, I'm going to audit everything, and including your bank statements and where every dollar you deposited came from. And they saw that ministers that got paid on 1099s in that process, they could say for audits, for ministers, if a minister gets picked by the computer, they could say, let's audit them. Let's make sure if they got a 1099, let's audit. And are they appropriately as a 1099 or should they have gotten a W-2? So, and the other issue is if you're being paid on a, should have been paid on a W-2 and sent a 1099, they could penalize the church for not giving W-2s out, for not treating properly those things. In the audit world, the housing allowance for ministers is subject to audit. And if you fail to properly document the agreement of the amount of housing allowance, or fail to substantiate the 3 limits you got, remember they got 3 amounts: the amount you set with the church that they paid you as housing allowance, the fair rental value of your furnished house plus utilities, and what you actually spent. So if you fail to document that you did that comparison of those 3 numbers and that you're claiming the smaller of the 3 numbers, they could find you on an audit, could be a red flag for the audit. If you get reimbursed by the church under a written accountable plan, and yet you don't have a written plan, and you don't have an authorized accountable plan, if the plan you're being reimbursed under doesn't meet the qualifications of an authorized accountable plan, they could fine you for that. They could call all the reimbursements you got taxable income. And you got to prove that, you know, I did everything right before they would go into that. Now, you always have the right in all those things to take something to court. You generally have to, and we'll see it on the next slide, I think. If you're audited and you do owe additional taxes, you generally have 3 options. You can pay the tax due immediately. You can request a payment arrangement, and penalties and interest will continue to accrue while you're doing your payment arrangement. One thing that's true with payment arrangements, you can do a short term, generally less than a year, or a long-term payment arrangement. I know some people that have done long-term payment arrangement owed the IRS, not because of an audit, because of things they filed and they couldn't pay it. They owed the IRS thousands of dollars, $20,000, $30,000, $40,000. And they made a payment arrangement. The IRS accepted that. And the payment arrangement lasted for 10 years. So long as that the payment arrangement can last. When the payment arrangement was over, which was December of last year, the IRS went and took, or they went and sent in a December payment. The IRS has to refund that payment because their payment arrangement's over. Now their payment arrangement, I'm going to agree to pay you X dollars a month for next 10 years, for next 2 years, next 5 years, whatever it is. They take your offer and they compare it to what they think they could come up with from you over the next 10 years, including any refunds you get, because if you're in a payment arrangement, you don't get refunds. Those stay with the IRS. Anything they think they can make you pay beyond, you know, they know that you can pay, say you've agreed to pay them $400 a month. Okay, they for 10 years, that's $48,000. Okay, and they're going to look at your situation and decide in 10 years, do they think they can come up with more than $48,000 or less than $48,000? And if they come up with their analysis says less than $48,000, they'll accept your payment arrangement. If it comes up with they think they can collect more than $48,000, they will reject your payment arrangement. The third option there is you can make an offer in compromise. A lot of paperwork, a lot of time involved. You have to make an application for the offer in compromise. And to support your application, you need a financial statement, a 633 A, B, or C, or D, or E, or F, or G, or whatever form 633 you qualify for. And you got to send in the last 6 months of income, the last 6 months of expenses, the last 6 months that you got to send all that stuff with your payment request, with your offer in compromise request. And they're going to take that and look at it and once again decide, do they think they can collect more from you, or do they think they can collect less from you than you're offering? If it's more, they're going to reject your payment arrangement, your offer in compromise. If it's less that they think they can collect from you, they'll accept it. So they're not out to make friends here. They're out to collect money.
Also, when you owe money like that, why is it that, say for instance, you make the payment plan, you agree to make a payment plan, and you miss a payment and they add interest on top of that? Why is that?
Because it's late. If you keep your payment arrangement every month, make your payment every, I advise my clients, if you're going to have a payment arrangement, set up an account with the IRS and make your payments through that account, and you don't question whether it's in the mail or got lost or whatever. You know that that you did it on the payment arrangement, you got proof that your account got debited for that on that day and it went to the IRS directly. You don't have to worry about it. Now, those who choose to mail a check in, sometimes postal service doesn't work, especially during pandemic. I mean, it was not uncommon for us to wait 2 or 3 months for a check sent to the IRS to be cashed. So their rule is, if you miss something, even by 1 day, now 1 day may stretch it a little bit, they may show a little leniency on 1 day, but if you miss something, they're going to charge you interest, and you have possibility that you will default on your payment arrangement or your offer in compromise, and anything you have paid them went to your account, but your account can no longer be satisfied by completing your offer in compromise or the payment arrangement you got with them.
That seems a bit harsh and unfair.
Well, like I said, they're not there to make friends.
Right.
This group's there to collect money. So now, if you want to have friends, it's better to not get into a situation where you got something here that you got to do. So those are the 3 options you have if you owe money. They've also got some situations where they look at the employer. The employer is responsible for paying taxes withheld. And if a church has non-minister employees, say a secretary, she can't be qualified as a minister. That was sexist to me. The secretary can't be qualified as a minister and not subject to the rules of ministers. So they have to withhold Social Security, Medicare taxes, they have to withhold income taxes, they have to get W-4 and a G-4, et cetera, et cetera. And depending on how much they withhold from her, from him, from the secretary, they may need to pay those taxes monthly, they may need to pay them quarterly, they may need to pay them within 5 days, 3 days, banking days of when they did payroll, et cetera, et cetera. So there's different rules there for how much payroll taxes they owe, depending on when they have to pay it. But if they fail to properly report and pay those taxes, that could subject the church and potentially subject the minister to a payroll tax audit. I have dealt with a church that did some 941s. The 941s are the quarterly reports that you send in for payroll. And the 941s for the year didn't match their W-2s for the year. And on the 941, they actually showed Medicare, Social Security, and Medicare taxes when all they were paying was a minister. The church had tried for 5 years to get the IRS to look at that and agree that they didn't know the Social Security and Medicare taxes. Because a minister doesn't, you don't withhold Social Security and Medicare taxes from minister payroll. It took me another 5 years before we finally got somebody. I could talk to IRS people all day long, and they would tell me, yes, I agree with you, but I can't change it. I can't go in, I can't find the person. I don't know who to tell you to talk to. So it took me 5 years to find the right person that could go in and say, oh, I understand what happened. We'll fix that. It took 10 years to fix it. So ministers' salaries, ministers' W-2s, those can be very complicated stuff, especially when you deal with the IRS and the average IRS agent doesn't know what they're looking at. So an average IRS agent, if you got an audit notice and just an average IRS agent, I would ask if they have done a minister before. They have audited a minister before. If they know some of the special rules that apply to ministers. If they know that you're an employee for payroll tax purposes, but is self-employed for Social Security, Medicare tax purposes. So you got dual status. So if you got the implication that they didn't know what you're talking about, I would ask that they reassign the audit to someone who has familiarity with audits and ministers. Because just Joe Blow IRS agent auditing a minister is probably not going to turn out well because he doesn't know enough. If you didn't pay payroll taxes when you should have, the IRS can come in and impose a 100% penalty for failure to properly pay payroll taxes on everyone who they deem to be a responsible party. And a responsible party is anyone with knowledge and the ability to pay who fails to fulfill the obligation to pay. We see this a lot of times with companies that are running into financial difficulty. They'll say, well, I'll pay this vendor and this vendor and this vendor, and I'll hold off on paying the IRS on my payroll taxes because I need these vendors to continue to bring work in so I can really, so I can try to get out of this. So anyone who had the knowledge that they had chosen not to pay their payroll taxes, and anyone who had the ability, i.e. signature authority over their bank account, I can sign sign a check and pay the bill if I want to. So anyone who had those two criteria and met those two criteria, the IRS could impose a 100% penalty on multiple people. Now, if they impose 100% penalty, and if one person decide they're going to pay the penalty, then everybody else is freed from the penalty. They can't collect, say they got 5 elders and all of them have signature authority and all of them decided that they had knowledge that we're not going to pay the IRS their payroll taxes this month. We're going to pay these vendors instead. They could impose the penalty on all 5 of them. And if one of them said, I'll pay the penalty, then the other 4 got away. They don't have to pay up. And they're no longer, the penalty is no longer assessed against them. The penalty is in lieu of the payroll taxes. So if someone pays the penalty, the church doesn't have to pay the payroll taxes. So this penalty is mainly to just ensure they have another way to collect money. And we see a lot of court cases where they've imposed a penalty for failure to properly pay payroll taxes, and somebody's fighting it in court. But they can do that. So the IRS requires a 1099 NEC be issued for any non-employee. If you have a custodian, if you have policemen who do traffic control, if you have visiting ministers, if you have, as we do, Georgia School of Preaching, the teachers and those that get paid for teaching classes, and if they make more than $600 in any calendar year, then the IRS requires you send them a 1099 NEC. Failure to issue 1099s can subject the church to penalties for each failure. 1099 NECs are due by January 31st every year, based on prior year. So by January 31st this year, we had to send out all the 1099 for 2022. If somebody failed to do that, there's a penalty for each month or portion of a month that they failed to do that. There's a penalty if they fail to issue any. So the best rule is send as many as you can by January 31st. And if you've got someone that didn't give you their social or didn't give you enough information so you can give them a 1099, you can do that one later. May have to pay a penalty on it. But if I were in business, I wouldn't necessarily continue to do business with somebody like that. A lot of times we get visiting ministers coming in for hold a meeting for us, and we present them with a W-9 when the first day they show up. We say, fill this out and I'll have your check the last day you're here. So if they don't give us a 1099 or W-9 rather, so we can fill out a 1099 on them, we don't give them their check. No, that's our control over making sure we get the W-9 from them. if a non-employee fails or refuses to provide a social security number for 1099 reporting purposes. Now, I talked about the W-9 earlier. We can what is called backup withholding. So if you were going to pay a guy $1,000 and you send him a W-9, said, before I pay you, I need to have this W-9, and he refuses to give you his social, or he fails to give you his social, he doesn't fill it out, doesn't send it back to you, you can withhold 28% of that $1,000 you were going to pay him the $720, and the $280 you got to send to the IRS. That's backup withholding. You tell the IRS what it's for, and he can get it back if he can properly document who it is. A lot of times we see banks paying interest and they don't have a proper social for a bank account. So they don't know who to send the 1099 to. So they do backup withholding on that. They pay 42 cents worth of interest and they pay 28%. The 28% they withheld, you got to go to the IRS and claim it.
Now that 28%, you said that if they refuse to give the social, that 28% goes to the IRS. Now, is it also part of the Social Security, or is it just going directly to
just go to IRS.
Go to IRS, and that will be
state. Has nothing to do with their Social Security.
Oh, okay.
All that we're doing is trying to get their Social Security number so we can do a 1099 for them.
Okay.
And they refuse to give it to it. Just withhold 28%, or tell them you're going to withhold 28% of whatever they're due to be paid, and send that to the IRS along with their name and address, because you're going to send them a W-9, but it's not going to show their social. So go ahead and send the 28% to the IRS. That convinces people quickly to give their social out.
Okay.
Because they can't, if somebody's making $10,000 or $15,000, they can't afford to have 28% of it not paid to them.
Right.
We got the IRS rule that annual letters denoting contributions in excess of $250. There's a statement on there that they received no goods or services were received in exchange for these contributions. Failure of a church to include that statement on there can cause the IRS to disallow the charitable contribution deduction. And failure to have the letter in hand prior to filing the return can result in disallowed deductions. There was a situation, I think it was 2018 or 2019, where somebody had made about 50,000 in charitable contributions, but they didn't have the letter in hand before they filed their return. So the IRS told them they were going to audit. They called the charity. They got the letter, but the letter was obviously dated sometime after they had filed their return. And the IRS disallowed their charitable deduction per law. I mean, you've got to have, the IRS rules are, you've got to have the letter in hand prior to filing the return. And if you don't, the IRS is perfectly legitimately disallowing it. One other item I will state, if a minister is also an elder, and we see that occasionally, and has total compensation which exceeds, now this is an old number, it's probably about now it's $140,000. The church could possibly be subject to the excess benefit intermediate sanctions. In addition, the church could be subject to losing its tax-exempt status due to violation of the inurement policy. The statement that no part of the net earnings of a 501c3 exempt organization shall inure to the benefit of any individual. Now, a minister can be someone that we pay, but if we pay them too much and they become and they are in a leadership capacity, not as a minister, but as an elder, where they set salary and they set all the things, then possibly you could lose your tax exempt status because of that. So that's just a caution to be careful on paying your minister if you pay them too much, or if you pay them, as an elder and as a minister. All right, questions?
No.
Okay. Let me stop sharing. Let me pause recording.